So this is the only strategy you will ever need in terms of risk management. Yeah. The only strategy you ever need in terms of risk management. And this is professional risk management. Now, remember I told you something. This week I said, I don't care about your profit or your loss. Just one thing you do for me is that after tomorrow's market, you kind of make annotations on your chart and you forward to me. So for now, let's just look at this now. Why did I speak about annotations? Annotations will tell me if you actually understood the narrative of the market, yes. Because one thing is not just to trade, you must understand the narrative. And your annotations should include time, please. Yes. Your annotations should include time. Times like session open, session close. But I'm only concerned with these two annotations. Tokyo close and New York session open and London close. So make annotations of this thing and try to define structures and market narrative within these times and sessions. So for now, let's be looking at what you should be expecting in the market. And let me say for the prop firm challenge, you are buying a $10,000 account. And now let's look at how to trade these $10,000 accounts. This is professional risk management. You see, in trading, I don't care about your strategy. I don't care how much you make today. My problem is, can you keep making it for the next 1 month? I don't care how much you make for the next 1 month. My problem is, can you make this money for the next 6 months? I don't care how much you made for the next 6 months. My question is, will you be able to make the same amount of money for the next 1 year? And even if you do for the next 1 year, another question is, will you be able to do this for the next 5 years? Yeah. The difference between the professional traders and some persons who think that trading is a get rich quick scheme is just that if you jump into trading with a mindset of making money, you will die. You will live before you survive because the heartache will finish you up, because trading appeals to your greed, your ego, your selfishness, and some other things. So now let's not just waste much of our time. We are trying to put up professional risk management here. So let's say you have a $10,000 base capital, and we'll be risking only 0.5% of the $10,000 account. So 0.5% of the $10,000 account will be $50. Let me put this here now. So the 0.5% of the account will be $50. So for every trade you want to take, you have to risk $50. Now, let's just look at how we can shrink. Okay. Okay, no problem. So let's just look at how we can shrink this whole stuff into what is expected of you. Now, let's put it this way. Let's say you have a trade, and let me just put up something, for example. Now, just look at this, for example. If we wanted to take this trade from this end now to here, we are trying to buy. This is just an example, please. So looking at this trade now, for example, we wanted to risk only $50 in this trade. and trying to risk only $50 in this trade, we'll look at maybe from the point of our entry to the point where we'll say if the market gets to this level, this bias or this idea is considered invalid. That is where we're going to place our stop loss. And let me say our entry is this level and we're going to be placing our stop loss here. That means if the market violates this level, price level, it means this setup or this our bias is considered invalid or has been negated. So, and from our entry to our stop loss level is 10 pips. So what do we have to do now? Let's bring it now. Let's factor it into this $50. Remember, we are trying to risk 10,000, 0.5% of $10,000, and which is $50. And since this is $50, what do we have to do? We'll say, for now, we are trying to calculate our lot size and we're trying to do everything professionally. Now, let me give you this formula. This is the formula you use. You say, sorry, that's wrong. This is the formula you're going to use. You're going to say the amount of money which you want to risk, which is in this case is $50, divided by the number of pips, which is in this case is 10 pips, further divided by 10. 10 is a constant. So the formula is just simple. The amount of money you want to risk in the setup divided by the risk in pips, further divided by 10, which is a constant. So let's do it this way. We'll say 50 divided by 10, further divided by 10. So we'll have 0.5. That means for this trade setup, our lot size should be 0.5. This is a professional way of trying to get your risk and lot size. So for this trade now, our lot size is going to be 0.5. Lot size will be equal to 0.5. That means, now what does this thing tell us? It tells us that if the market moves against us, we're going to lose only $50. Now, remember this formula, the amount of money you are trying to risk in dollars divided by the stop loss, number of stop loss in pips, further divided by 10. This 10 now is a constant. You do this over and over and over again just to maintain profitability in the market. Now, I always encourage people to make sure that their risk to reward, your risk to reward is never less than 1:2. Always make sure that your risk to reward is never less than 1:2. Please, if your risk to reward goes below 1:2, it's not always safe. Now, if you want to take a trade, target a minimum of 1:2. Now, we're going to be doing a professional calculation on how this thing will affect your trade in the long run. Now, if you apply this very thing I'm telling you time and over time again, there is no how that by the end of every month, you will not be profitable. Yes, it's a professional approach. Now, please, this is a professional approach to lot size calculation. Now, let's look at this now. Let's use coin flip. Let's say if we get head, which means the trade went in profit, we are getting 2. And if we get a tail, we are getting 1. Meaning, if we take a trade and it enters for us, it moves to profit, we're going to get a +2. And if the trade hits a loss, which is going to be a tail, we're going to get -1. So now we'll do 10 coin flips. 10 coin flips. Let me number it out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now we're gonna do 10 coin flips. I'm trying to write it out on a piece of paper, and I will show that on the screen. And for every head, which means a win, we're gonna be gaining a +2. And for every tail, which will mean a loss, we're gonna be getting a -1. So let's go now. Coin flip. This is as simple as that. I'm trying to show you how risk management affects your trading in the long run, not minding your strategy. Now let's go. So we got a head. It's going to be +2. This is our first trade, for example. So our second trade, let's see what we got. Okay, we'll have a tail. So -1. Third trade, we got a head, +2. Fourth trade, let's see what it gives us. We'll have a tail, -1. This fifth trade, we'll have a head, +2. Let's go again. This is a sixth trade, for example. We'll have another head, +2. Let's go again. We'll have another head, +2. That's what goes. This is a seventh, eighth trade, for example. We'll have another head, +2. So let's see. We'll have another head, +2. And for the 10th trade, we have another head, +2. So what did we have here? We had 1, 2, 3, 4, 5, 6, 7, 8. We had 8 trades in profit. So that means let me write it out here. Out of 10 trades, 8 was profit, which means 8 times 2 will be equal to 16. And out of the same 10 trades, 2 was in loss. So that 2 that was in loss is going to be 2. We had 2 that was in loss. So and for every loss, we had -1, -1. So that's going to be in total of -2. So at the end of the month, our profit percent is 16 minus 2. So we had a 14%. So we had a 14% return. So I hope you see this now. Out of 10 trade, 8 was in profit, 2 was in loss, and at the end we had a 14% return. Now, let's go back to our coin flip and we'll try another scenario now. Let's flip again. We are trying this again for 10 trades. We have a tail, which is -1. Let's flip again. We had the head, which is +2. Let's flip again. We'll have head, which is +2. Let's flip again. We'll have tail, which is -2. Let's flip again. This is for the 5th trade now. We'll have a head, which is +2. Let's flip again. We'll have a tail, which is -1. Let's flip again. A tail -1. Let's flip again. We have a tail -1. Let's flip again. We have a tail -1. Let's flip again. We have a head +2. Let's flip again. this will be the last trade. We had a tail -1. Now, let me show you something here now. 10 trades again. Out of the 10 trades, we had only 1, 2, 3, 4, 5. 5 was in profit. 5 was in profit. And remember, we said for every profit, we had a 2% return. So we're going to do 2 times 5, which will equals to 10%. Now, we had how many loss? 1, 2, 3, 4, 5. Excuse? We had how many profits? 1, 2, 3, 4, 5. How many loss? We had 1, 2, 3, 4, 5. We had 5 loss likewise. So we had 5 was in loss, and 6 we had 5 trades in loss. What should we be expecting? For every loss, we're having a -1, so we're having a -5. So in total, what did we get? In total, we have 5% return. Are you seeing it? In total, we had 5% return. Now, let's put up a scenario whereby, let's say, we had let's come up with a scenario that, let me say, we had 6 losses and 4 profits. Now, 10 trades, we had 6 losses, which will automatically mean -6, and 4 profits, which will imply 4 times 2, which will give us 8. So percentage total return, we will be saying 8 minus 2. So worst case scenario, we're having 2% return. 2% return. So that's one thing with playing by an excellent risk management. Even if you lose 10 trades, even if you lose 7 trades, for example, and that means -7, and out of a 10 trades, you won only 3, you are only down by -1%. You are only down by -1%. So if you don't play by an efficient risk management rules, you are gambling and you will destroy your capital. That's why, far from your entry, your risk, your this, your that, if you don't understand risk management, I don't care what your technical analysis is, when you enter, how you live, you might make money today and you lose it to the market the next day. Yes. You make money today, you lose it to the market the next day. Now, for every trade, you determine the amount of money you want to lose and let it be in a fixed percentage return in terms of risk and reward. Now, don't be too greedy. Sometimes maybe you've already met your reward of 1:2. Greed will make you still hold on. You are ready to lose everything to the market. The market is fixed. It's mechanical. Yes. But you have to be flexible enough in terms of mindset to be able to flow with what is going on. Yes, since we'll have a lot of things that will be involved in the market, which includes ego and greed. So all those things has a way of maneuvering or manipulating your mindset, your thoughts, and your conceptions to breaking your rules. I know this will not be difficult. This will not be easy for you. It's going to be difficult, quite all right. That's why I said, if you see a profitable trader, believe me, he has sat or stayed with another profitable trader. Trading is not something, you don't bring in smartness into the trading. You actually look at people to ask them what works and what does not work. So at those very points, I'm keeping it simple, and I really want us to call it a day. So this is me saying to you, please take everything I've said here and so far very serious.